The Peter Schiff Show.
Today's episode is sponsored by Omaha Steaks, with high-quality beef that's naturally aged for the ultimate tenderness, juiciness, and flavor. To get $30 off your qualifying order, go to omahasteaks.com and use the promo code GOLD at checkout. Minimum orders may be required. See site for details. Well, I am back in Connecticut in my basement once again. Welcome to the 900th episode of the Peter Schiff Show podcast. 100 more episodes to go to get to 1,000. And, I want to report that I was able to return to the United States from the UK without any episodes at the border. And I think I mentioned this on a podcast a while ago. But for a couple of years, I had a very difficult time coming back to the United States. It all started shortly after the 60 Minutes defamatory broadcast that accused me of using my bank to help criminals launder money and evade taxes. After that, I noticed that I had a hard time coming back to the States. Whenever I came back and I was going through customs, they would see my passport and immediately would pull me aside. I'd have to go to a special room where I'd have to wait, and then I'd get interrogated by somebody, ask me a bunch of questions, look through all of my luggage, and then I would eventually be able to, come back in. And also, I don't know, about a year ago, or maybe not quite a year, I forget, but I lost my global entry. I had been a member of global entry for a long time. If you don't know what that is, it's something that you get, you apply with the government, you got to go down and they run a background check on you, and then they give you a global entry. You also end up getting TSA pre-check for free when you're a member of global entry, and you get this known passenger number with that. But it just means too that I could get back into the US quicker because you go to a shorter customs line. It's more automated. Well, anyway, shortly after I renewed my global entry, for like another 4 or 5 years, I paid the fee and I renewed it. And in less than a year after I renewed it, I lost it. I got told that I no longer had global entry. In fact, the only reason I found this out is because my pre-check was no longer working. And so I lost that because I lost my global entry. But I never got an explanation. I tried to get it. I even used Freedom of Information Act, but I could never get anybody at the government to tell me why I lost my global entry. But I think it all had to do with the investigation of me, because of the bank for money laundering and tax evasion. I must have been put on this list of suspicious people. And so my passport was flagged, and anytime I came back into the country, they just assumed that maybe I was out there laundering money. And so they wanted to, really check me out. Well, the first time that I didn't have a problem coming back to the United States was a few months ago. I came back to Puerto Rico from St. Bart, and, I was expecting to get interrogated, and they let me through. And I wasn't sure, maybe it was just, a one-off event. And so I was kind of nervous coming back into this country. Not that they would find anything. I mean, I don't smuggle anything. I mean, so it's just a hassle that I have to take longer, to get out of the airport. After a long flight coming back from the UK, you don't like to spend a couple of hours, waiting for the customs officers to clear you. But I sailed right through. Just a couple of standard questions, no big deal. Got right back in. And so I think it's over. I think what happened was, while this investigation was ongoing, I was on this list. But the fact that I'm no longer on the list, maybe that tells me that the investigation is over. And I've assumed it was over because they ended the investigation on the bank a long time ago. But it pissed me off in that press conference that the Puerto Rican regulators called to announce the fact that they were putting my bank into receivership. instead of allowing it to be sold to Kenta, which is the company that had bought it or was buying it, waiting for government approval. By the way, it's almost been a year now. It'll be a year on June 30th that my bank had been in receivership, and not a single customer has gotten any money back. I mean, all the money is there. I mean, there's not as much there now as there was a year ago because they've been spending it, right? But there's still enough there to make everybody whole, as far as I know. But nobody has gotten a nickel yet because of this government process. But during that press conference, the IRS guy was there, the top IRS guy in the criminal division. And he disclosed the basically failed investigation of my bank because no charges were filed, because no evidence of any wrongdoing was discovered. But he made it sound as if we were doing something wrong. We just, got away with it, right? But somebody asked him, well, what about Peter Schiff? Is Peter Schiff under investigation? And the guy said, well, we're not allowed to comment on who may or may not be under investigation, after he just finished talking about how my bank was under investigation for 2 years. So if you're not allowed to comment on investigations, then why the hell did he comment on the investigation about my bank? Especially since he knows the investigation exonerated my bank, yet he didn't want to mention that fact. So he just wanted to pretend that the bank did something wrong. It's just that, nobody got charged with anything because I guess they couldn't quite find enough evidence to pin it on anybody, but they just assumed that this bad stuff was going on. But with respect to the question about me, he just said, well, I can't comment on whether or not Peter Schiff is under investigation. Now, why not? I mean, he just commented on the bank. Now, I don't think he should have commented on the bank. I think that was wrong. But once, he had the precedent of doing that, he could have said, well, no, we're not investigating Peter Schiff, or we did, but we closed it. No. He didn't comment on it, because I think he wanted to leave the false impression out there that there was some open investigation about me. And so that's why I haven't been charged yet, because they haven't finished the investigation. They wanted to leave that specter out there that, yes, Peter Schiff may be guilty of these crimes. We just haven't finished the investigation yet. And so it's an open matter. And, they never want to come out and say there's no more investigation. But the fact that I can now return to the country, to me, is some indication that maybe they did officially close this investigation, to the extent that, I'm no longer on the suspect list of money launderers or tax evaders. And so I can, come back into the United States without a hassle. So, I mean, that was comforting, because I've been traveling under this stigma. And I finally ended up getting my TSA pre-check back, but I had to get that directly. And I got approved for that. So I lost the pre-check. I mean, the global entry. And maybe I would get it back. I don't even know if I applied again, maybe they'd give it to me. But they never told me why they took it away in the first place. Anyway, I'm going to get on with the podcast. First thing I want to discuss is the jobs numbers, the weekly unemployment numbers that came out yesterday on Thursday, because this was a disappointment to the markets in that there was a big spike in weekly jobless claims. The prior week, they were at 223,000 claims, and it jumped up to 261. That's a big jump in a single month. I mean, way above expectations, but a very large jump. And in fact, the number of people filing first-time unemployment claims is now the highest since October of 2021. So in the prior week, the markets were celebrating or heralding this great jobs report when all these jobs were being created. And now we get a very bad weekly unemployment number, a week later. And again, I have been very suspicious, and I've been voicing my suspicion on this podcast of the jobs numbers. We've had, 12 out of the last 13 jobs reports have beat estimates. And these labor numbers, or these job numbers, this is what everybody is hanging their hat on, to claim that we have a good economy because we have this supposedly strong labor market. Well, the employment numbers have been the only good numbers, and they're only good superficially, but they're the only ones that are. All the other numbers are bad on the surface, and they're even worse when you dig deeper. So the unemployment numbers are the outlier. But they are inconsistent because remember, even though we keep getting these official job reports that are stronger than expected, the household survey, which is released at the same time as the official numbers and doesn't really get much media attention unless the official number is bad and the household numbers are good. See, when that happens, the media finally talks about the household numbers. But when the household numbers are bad and the official numbers are good, well, the household numbers don't even exist, right? Nobody wants to talk about it, especially when, you got Joe Biden in the White House and the media wants to pretend we've got this great economy. So they want to ignore economic data that would cast doubt on that narrative, and they want to just focus in on the data that seems to support, this robust Biden economy. But the fact that you've got this big contradiction between the household numbers and the establishment numbers, that in and of itself casts doubt on the jobs numbers. But then when you see these unemployment numbers, that's also an inconsistency that casts doubt on these numbers. The layoffs that are announced every week cast doubt on these numbers. So there's a big cloud, I think, surrounding all these unemployment numbers. And so I think that you can take them with a grain of salt. And to me, if you're going to look at the unemployment numbers and say we have a good economy because we still have, this strong labor market, then you have to believe that all the other economic data
them. But for many, many years, and still including today, it's this report, which is the granddaddy of the monthly reports. Everybody waits for this number. And I'm not even sure why, because to me, it's pretty insignificant given how completely unreliable these numbers now are. I mean, everybody is looking for a strong report as evidence that the economy is good. And so somehow we keep manufacturing these strong jobs reports. In fact, the report that we got on Friday was the 13th consecutive beat where the number of jobs created exceeded what Wall Street expected. Now, what are the odds of that? 13 times in a row? I mean, you're going to have a few misses in there just by pure chance. I mean, how could the expectation be too low every single time? I mean, it seems more likely that the government knows what the number is and they just want to beat it. And so they end up doing it. I'm a little skeptical of a streak that goes on for 13 consecutive months, especially given how weak the overall economy is. Because what's happened during those 13 months? Well, the Fed has taken interest rates from 0 to 5.25. Seems that would be a difficult environment for job creation. Also, look at all the layoffs that we're getting. I mean, tech companies are laying everybody off. Banks are laying off. In fact, we even got on Thursday, before we got this non-farm payroll number, we got the number of job cuts from Challenger. And it was another pretty big month. It wasn't quite as big as last month. They reported 89,703 job cuts. This month, it was 66,995. But that's still a lot of cuts. These are much bigger numbers. And it stands to reason that companies would be laying off workers. I mean, now they're laying off workers because of AI. But before that, they were just laying them off because their businesses are collapsing because their costs are rising and interest rates are rising and consumers are struggling. Companies have run out of money. And so they're having to cut their workforce just to reduce their cash burn. So it would make sense, right, that we wouldn't have a lot of jobs. Yet we keep coming out with these strong reports. So first of all, here is what the government reported for April. So the expectation was 178,000 jobs, and that would have been less than the 236,000 jobs that were reported for March. We came out with 253,000. So a solid beat. In fact, the range of expectations went from 140,000 to 200,000. So we came out above the high end. But there was one wrinkle. Nobody seemed to talk about it. But there was a downward revision from March from 236,000 all the way down to 165,000. It was basically a push. I think if you take the 2 months combined and you net out the revisions, it was only a beat of 2,000 jobs. But nobody really talked about the downward revisions to March. It was all the beat from April. Now, of course, I don't really remember what the expectation was for March that the government beat, but I don't know, maybe 165 wouldn't have been a beat. So maybe this isn't 13 in a row if you go back and look at the revisions. But any number that's subject to that kind of revision, again, Wall Street puts a lot more stock in this number than they should. The unemployment rate fell from 3.6 to 3.4. Private payrolls also beat, but again, subject to a similar downward revision. They were looking for 153,000. The government reported 230,000, but the 189,000 that they originally reported last month was revised down to 123,000. So that was a big number. Same thing on manufacturing. They were looking for no new manufacturing jobs created. Instead, they created 11,000, but last month's loss of 1,000 was revised to a loss of 8,000. So almost a push. The labor force participation rate stayed steady at 62.6. One number that did beat, which should have been a negative for the markets, was average hourly earnings. They jumped from 0.3 to 0.5. And the year over year increase in average hourly earnings went from 4.2 to 4.4. So these were hotter numbers. And the market is very sensitive to anything that looks stronger or looks like higher inflation. The bond market reacted as it had been, right? Bond prices sold off, yields rose. Gold did what it always does when we get stronger economic data. And they define hotter inflation as stronger data, which doesn't even make any sense. But gold dropped. As soon as the number came out, gold sold off by $40. But it was near a record high on Thursday. Gold was trading above 2,050 when this stronger than expected number came out. And gold immediately tanked by $40. It closed down about $30, still well above 2,000. I think we're trading about up $1 right now in early trading on Sunday night. Gold's about 2,020. And even though gold stocks initially got clobbered on the $40 drop in the price of gold, by the end of the day, they were broadly unchanged. I mean, some of the stocks actually finished positive on the day. So to me, with gold down $30 and gold stocks flat to positive or down just a little, again, that's showing me that 2,000 is the support. And gold stock traders are now starting to recognize that. In fact, this time we couldn't even get below 2,000. We had been trading below 2,000 on the sell-offs, but on this $40 sell-off, we couldn't even get to 2,000. That's how strong the market is. The one market that seemed to act different than it had been acting was the stock market. The Dow Jones, despite this strong economic data, remember, good news is supposed to be bad news for stocks, and bad news is good news. This jobs report was taken by Wall Street as good news, and it had within it, bad news on inflation, meaning bigger numbers. Yet the Dow was up 546 points. That's a big move. And in fact, the NASDAQ on a percentage basis was up even bigger. I think the NASDAQ was up 2%, and the Russell 2000 up about 2.4%. So all these equities rose. And in fact, the riskiest equities rose even more. I think the Cathie Wood ARK Innovation ETF was up about 4.5%. Now, maybe shorts covered. Maybe that's what was going on. We had this stronger than expected economic news that should have been bad for stocks. Instead, stocks rallied anyway. I still think that we're going to see more downside in the stock market because my take, and I gave this to everybody on the last podcast on Wednesday following the Powell press conference, where Powell basically threw cold water on the idea that the Fed has paused, that we're finished with the rate hikes. And then he went even further by saying the expectation that we're going to cut rates is wrong. if anybody thinks we're going to cut rates, and of course the market is certain that the Fed's going to cut rates this year because it's already pricing it in. But despite that, Powell said, no, we're not going to cut rates. We're going to keep rates where we are. We've got to fight inflation. Given the fact that that's what Powell's saying, forget about what he's ultimately going to do. But given the fact that that's what he's saying, that is a powerful headwind for stocks. So I expect them to be moving down. But I want to talk a little bit more, though, about the jobs numbers, because once again, you really got to look beneath the headlines to see these numbers, because these are not strong numbers. And again, when you're looking at the jobs report, they're counting jobs. They're not counting people who have jobs. It's not the number of people who are working. It's how many jobs the people who are working have. And so what most of these new jobs represent are people working second, third, fourth jobs. That's what they are. They're not people coming into the labor force who weren't participating and now they've got a full-time job. These are people that are already working their butts off and now they have to work even harder to make ends meet. But if you look at the household survey, compare that to the number, again, the household survey, which I think is probably more accurate on people working, that had 139,000 jobs added. That was the lowest number since November of last year. But what really stood out this month was the jobs that were added as a result of the birth-death model. Now, I haven't really talked a lot about birth-death on the podcast recently on these payroll numbers. If you're not familiar with that, the way that works is the guys that compute these non-farm payroll numbers, they're supposed to try to guess the number of jobs that were created or lost based on new businesses that were either formed or, existing businesses that were shut down. Now, they don't actually have the data, so they kind of wing it, I guess. I'm really not sure what the methodology is. I think it's probably highly subjective, because if you think the economy is good, well, you're just going to assume that new businesses are being formed. So you have that bias. If you think the economy is bad, well, maybe you'll assume that some businesses are folding and they're going out of business. So we know that everybody in the government thinks we have this super strong economy, and that's shrugging off inflation and rate hikes. And so if you have that kind of bias, maybe that's why they keep assuming that all these new businesses are being born, when it's probably more likely that existing businesses are dying off. So that automatically means the number is going to be way off, because instead of subtracting jobs based on companies that went out of business, you're adding jobs based on fictitious companies that never really started up, but you're just assuming it. But this month's number assumed, and I got this stuff from a Zero Hedge article just to give them a plug, but the birth-death model for April was 378,000 jobs that were added. That is the second highest ever. How is it that this economy is so super strong right now that we just had new businesses being started and hiring the second largest number of workers in history? That doesn't make any sense. That doesn't even come close to passing the smell test. And in fact, if there were only 253,000 jobs created total, yet the government assumed that brand new businesses that they don't even have proof were formed, if those so-called new businesses added 378,000 jobs, that's all the jobs. That means if it wasn't for these businesses that the government assumes were created last month, this is just 1 month of new business formation, right? Assuming they weren't existing, 125,000 jobs would have been lost. So that means the businesses that we know are operating, they fired 125,000 people, or they got rid of 125,000 jobs. Who knows how many people that represents, right? Because some people could have had 2 or 3 of those jobs. But 125,000 jobs were lost by companies that they know existed. But then they assumed that 378,000 jobs were created by companies they're guessing started up during the month. So none of this makes any sense. All these numbers, I think, are just, pulled out of a hat. And they're very likely to be massively revised, whether it's a month from now or even a year from now. They go back and they fix this because they know how inaccurate it really is. So given how wildly inaccurate these numbers actually are when they get reported, it makes no sense that Wall Street should put so much stock in this data point. So I'm going to talk now about some other data points that I think are more important than the payroll numbers that came out on Friday. But before I do,
I was stealing or how many rules and regulations I was breaking. But because I was so critical of the rules and regulations, I had to make sure that I abided by them. But anyway, I just went off track. I want to get back to what I was talking politics. The other twist that might be coming is that Biden may in fact not be the nominee. And I've heard a lot of talk, and it makes sense. People want to compare the current situation of Joe Biden to the situation that Lyndon Baines Johnson was in for the 1964 election. So Johnson became president when JFK was assassinated. And he won election in 1960, I got my dates wrong. So he became president and he won the 64 election. It was the 68 election that I'm going to talk about. So he was elected in 1964. He became president because Kennedy was shot. He beat Barry Goldwater, who, in my opinion, was probably the best candidate the Republicans ever fielded. I mean, Ronald Reagan, in a way, might have been better than Barry Goldwater, but I don't know that. I think Barry Goldwater would have been a better president than Reagan, right? But Reagan was a great candidate, and Reagan was a big Barry Goldwater fan, and so was my father. I mean, my father campaigned hard for Goldwater. Most people back in the day too. I mean, were Rockefeller Republicans. The Republican Party was very far to the left, and so the fact that Goldwater even got the nomination was a major move for the Republican Party, and that laid the foundation for Ronald Reagan to win in 1980. But the Democrats loved that. I mean, they were so far left back in 1964, but they were able to win, based on the fact that the Republicans nominated Goldwater. But he would have been a great president, Barry Goldwater, and the country might look a lot different today had we elected Barry Goldwater instead of Lyndon Johnson, because then that started the war on poverty, the Great Society. A lot of stuff happened, Vietnam, a lot of bad stuff happened because of Lyndon Johnson. He's probably one of the worst presidents we've ever had. Maybe he's even the worst. I mean, it's a tough call. We've had a lot of bad ones, but he was pretty damn bad. But anyway, so he won in 1964. And so in 1968, he was unpopular. I mean, there was a war going on in Vietnam that was very unpopular. And there are other problems in the economy. And so he was low in the polls, but he was an incumbent, and he was going to run for his, second reelection. And he had Hubert Humphrey was his vice president. For whatever reason, I don't know, but after Kennedy died and LBJ became president, he didn't select a vice president, right? So he served out the rest of that term without a vice president. But then at the convention for the 68 campaign, he picked Hubert Humphrey, who was actually I think he was a senator from Minnesota at the time. So he left the Senate, to become a vice president under Johnson in 64. So 64. So anyway, so 1968, Johnson's going to run for re-election, but then he gets challenged. Eugene McCarthy, kind of a relatively unknown guy in the Democratic Party, challenged Lyndon Johnson. Only guy willing to do it, because nobody wanted to go up against the standard bearer, the sitting president of the United States, right? Nobody wanted to, primary against that guy. But McCarthy did. And the New Hampshire primary came up, which is the first one, and McCarthy almost won. he got 42% of the vote. LBJ got 48%. And so that was a huge wake-up call. And the fact that this unknown guy did so well against such an unpopular sitting president, that caused Robert Kennedy, JFK's brother, the former secretary, what was he? He was the attorney general, former attorney general of the United States. He threw his hat in the ring and declared his candidacy for the presidency. Right? Shortly thereafter, LBJ ended up dropping out. He gave a famous speech. He went on television, said that he would not seek nor would he accept the nomination of his party to serve another term. So he basically bowed out because of the primary challenge. Now, of course, Robert Kennedy would have won. He won the California primary, and then a couple days later, he got killed. And so that allowed Hubert Humphrey, who was the vice president, to get the nomination and lose to Richard Nixon. And I think people are looking at what happened and thinking the same thing might happen again with Biden, because he is a very weak president. There is an unpopular war. Maybe it's not a war where U.S. troops are involved, but there is a war in the Ukraine and Russia. So that's there. But the economy is lousy. We've got stagflation. And the president, is basically, inept. I mean, everybody can see the problems that he has. Now, he is refusing to debate. He has one challenger right now, which ironically is Robert Kennedy's kid, right? JFK Jr., the nephew of Robert F. Kennedy, is running against Joe Biden. Now, so far, Joe Biden is kind of ignoring this guy, like he's no big deal, right? And he doesn't want to debate him. He's saying, I'm not going to have any debates. I'm the sitting president. Why should I have any debates? Maybe it's not a great example for success, but Jimmy Carter in 1980, when he was the sitting president, he was challenged in the primary by another Kennedy, Teddy Kennedy, right? Ted Kennedy challenged Jimmy Carter, just like Robert Kennedy, right, challenged LBJ. And, he wasn't shot. The primary, concluded. And Jimmy Carter won. But he did debate him. There were several debates between Carter and Kennedy. Carter didn't duck the debates, at least give the guy credit for that. He didn't hide out like Joe Biden is doing. He faced the challenge, And Ted Kennedy was a senator. He was a popular guy in the Democratic Party, had a great name, right? Kennedy. The closest thing to royalty we have in America are the Kennedys. And so Jimmy Carter at least primaried. But Joe Biden doesn't want anything to do with Robert Kennedy Jr. And I don't blame him because, I've listened to some of the things Robert Kennedy Jr. says. And I think he would beat the crap out of Biden in a primary debate. So it's not going to happen. Now, to me, Robert Kennedy Jr., there are things that he says that I agree with, right? So, but there's a lot of stuff that he says that I don't agree with. I mean, he is a big government guy. He's a big social welfare guy. He's not a big defender of free market capitalism, but he does criticize a lot of the stuff that the government is doing wrong that I also believe. I mean, he's kind of like a libertarian in a sense when it comes to certain issues, surveillance or, war on drugs. There are certain things that he wants to get rid of government for. Talking about government corruption, government and business, how they're cracking down on First Amendment. He was, against all the mandatory vaccines. And, so, I mean, he says a lot of things that would appeal to a lot of people. But the Democrats are acting like this guy is a Republican, that this guy is like another Donald Trump. I mean, he really is closer to what the Democrats were 10, 20 years ago than the Democrats are today. I mean, he's a lot of the issues that he's championing were Democratic issues. They're just not there anymore. I mean, the Democrats were supposedly, right, we don't want war, right? They, but now they're the warfare party. I mean, he talks about the neocons in the Democratic Party, but he's making a lot of noise for Biden. And so I think that as this primary season goes on, And Robert Kennedy continues to, beat up on Biden. And, he did a Twitter Spaces with Elon Musk. So that helped introduce him to a lot of people. And a lot of people are going to be looking for alternatives to Biden. But right now, other mainstream candidates are kind of reluctant to get into the mix. But I think that at some point, if Kennedy starts polling high enough, or even if we get to a primary and he has a good showing or wins, that's going to open up the door for like a Gavin Newsom to come swooping in and say, hey, I'm in it. Because if it looks like Robert Kennedy Jr. is going to win, I mean, it's going to be like a Bernie Sanders, right? The Democratic Party didn't want Bernie Sanders to get the nomination. He probably would have gotten a nomination.
Activity index for February. Now, the January index was at 23, and the expectation was for a slight decline to, it was 0.23, excuse me, forgot a decimal point. So January's number was 0.23. The expectation was for a decline to 0.18 in February. Instead, we dropped all the way down to minus 0.19, so the opposite side of zero. So weak economy. The 3-month moving average, though, I guess, moved up a bit from minus 0.26 to minus 0.13, but the data was still worse than expected, and it does show a contracting economy. And that was before this financial crisis started, right? This is all rearview mirror stuff. This financial crisis didn't kick off until March, so none of this is in the February data, which was already bad. Same thing with new home sales. New home sales were originally reported for January at 670,000. These are annualized numbers. That got revised all the way down to 633,000. That's a big downward revision. And then even after that downward revision, the February number was still weaker than expected, although not by much. They were looking for 645,000, and we got 640,000. But I would expect that even though mortgage rates may have come down a bit in this crisis, I think that this is going to send an even deeper chill throughout the housing market. Because a lot of these community banks now are having a lot of problems, and a lot of these banks are the ones that are writing a lot of these mortgages. So there's going to be a problem here for the housing industry. Kansas City Fed Manufacturing Index for March, not really sure here. It came out at a zero. It was, the last month was zero. I'm not sure if this number is correct. It looks like a weak number, but I don't really have much data on it. But I pulled it up. I already went over the balance sheet. Durable goods came out today, and another weak number. So the January number for durable goods was initially reported at minus 4.5. Came out at minus 5. So that number is now worse than they originally told us. They had expected an improvement in February. It was supposed to be positive 1.5. Well, they were right. It was an improvement, but it wasn't into positive territory. We got minus 1% for durable goods in February. So back-to-back negative numbers. If you take out transportation, they were looking for a gain of 0.3. Instead, we got 0. And core capital goods, which was supposed to come out, well, actually, I don't know what it was supposed to come out. It came out at 0.2. But we did downwardly revise the prior month, which was originally reported as 0.8, and it ended up being revised to 0.3. The one number that had some strength in it was the PMI that we got today for March. And so this has some part of March in it. And it came out at 53.3. I don't know what they were expecting, but I know that the manufacturing part beat expectations. It was supposed to be 47.2, and it came out at 49.3. Now, it's still sub 50, which still indicates contraction, but not as big a contraction. And the service number was much stronger. They were looking for 50.3, and we got 53.8, which was a much stronger number than forecast. And I think the main reason for that is prices. I think in the service sector, we're really starting to see momentum building in price increases. And I think that's really what's going on with that stronger number. I think it's just higher prices that are responsible for the increase. Now, there was a temporary decline in the goods prices because we had a decline in energy and other commodity prices as the Fed had tightened, and that was taking its initial effect. But now that the Fed has eased, right, now that there are no more rate hikes, yes, Powell raised rates by 25 basis points because I guess he said he was going to raise and he didn't want to not raise. But now that he's told everybody that he's not sure what he's going to do now, right? It's like we don't really know what's going on in the future. There's a lot of uncertainty. So he, as I said in my last podcast, he's opened the door to not hiking rates, which means he's not going to hike rates because the market is going to make sure that they push the Fed through that door and there are no rate hikes. So the rate hikes are over. The only question is, when is the next rate cut and how low will the Fed be able to take rates? I don't think they're going to get all the way down to zero again. I don't even think they'll get down to 1%. They will cut rates. They're just not going to be able to cut them that much because inflation is going to explode. And so that will, shorten the easing cycle. But of course, as inflation gets worse, that accelerates the amount of ease because not only are you lowering rates, but real rates are dropping even faster because as you're cutting rates, inflation is going up. And so the gap between yield and inflation just widens. But we're going to cut rates. Haven't done that yet. But just telegraphing to the market that you're done, that counts as a pivot as far as I'm concerned. I mean, is it a soft pivot because they haven't actually cut rates? Maybe. I don't know. I just think it's about as clear a sign as you're going to get. So anybody who's still looking for a pivot, you're mistaken. You got your pivot. It's here, right? And so you're just risking losing a lot by waiting for some official pivot before you change your investment strategy, to a defensive one against inflation because you're waiting for the Fed to really start cutting rates or cranking up the presses. They've already done that, right? But when it comes to quantitative tightening, that's gone. And not only did they stop quantitative tightening, they started quantitative easing. So what more evidence of a pivot do you need than that when it comes to what they're doing with money? Now, the Fed is denying, as I said on my last podcast, they're denying that this is QE because they're saying the intentions are different. So that's what makes QE, what your intention is. So QE is when you print money and buy government bonds and mortgages if your intent is to lower interest rates. But if you do the exact same thing, but you have a different intent, well, then it's not QE. Well, that makes no sense whatsoever, right? So it is QE. I don't care what these guys want to call it. And the only reason they call it QE is because they don't want to call it the only reason they call it QE is because they don't want to call it what it actually is, and that is inflation. And that's what they've been creating. And that's why we have this inflation problem. And that's why this problem is about to get a lot worse because the Fed has no choice. And in fact, Powell admitted that in the Q&A in a way when he refused to give any economic advice to Congress. He refused to criticize any of their policies. He just said, we take whatever fiscal policy we get and we just build it into our model. And we just do our best. Well, that means inflation. If they've just got to take any deficits that Congress wants to hand them, and they got to figure out, how to deal with it, well, they're going to print money. I don't care what they call it, QE, it's inflation. Even if it's not QE, it's still inflation. It's about to accelerate. And so everybody needs to do something now. Don't wait. Do it now. Yes, the price of gold is still below 2,000. It got above 2,000 a little bit intraday today, but it did sell off. Let me see where it ended up closing. It couldn't hold 2,000. Gold sold off close to 20 bucks. So it closed at 1972. Still a pretty strong close. Gold stocks shrugged off the drop in gold for a change and actually were positive on the day. So investors are now starting to buy some gold stocks, realizing that they're still super cheap given where gold already is. But most of these gold stock investors still expect the price of gold to go down as soon as this crisis is over. And again, they think that inflation is going to come down. It's not. Inflation is going to run out of control. but gold is strong. Yes, it hasn't closed above 2,000 yet. It will. I don't think there's much downside left. I don't think we're going to see 1,800 again. I think that ship has sailed. So I think if you got your eyes on prices that low, you're not going to be a buyer. You got to be willing to buy stock, gold here in the 1900s. I think buying below 2,000 is going to be a good price. You're going to look back at this a year or two from now and think of how cheap gold was when it was still below $2,000 an ounce. So you want to buy some physical gold. I know the guys at Schiff Gold, they're still working overtime. They're working weekends. They're taking your orders at schiffgold.com, and talk to the representatives at Europe Pacific Asset Management about getting your portfolios in order, transferring your accounts over. I don't know how much time we have left. I mean, I really think we're rapidly approaching the end of this, where the window is going to shut, right? And you have to have your financial house in order. You have to have all of it. And potentially we've seen a high, not only in Bitcoin, but a lot of these risk assets. I mean, what happened to Tesla today and that 10% drop, to me, looks like maybe we finally run out of room for these risk assets to rally. The reason they rallied so much was the market really got ahead of itself and looking forward at rate cuts, right? Well, because the Fed is going to be cutting rates because the economy is going into recession, and everybody just expects that recession means lower inflation. And so everybody was trying to get prepared for the next round of rate cuts and QE, thinking that this tech stocks would be the place to be because they were the place to be the last time the Fed cut rates to zero and went back to QE. Well, I've been saying that this time it's different. It's not going to be what worked last time that's going to work this time, because this time it's a period of high inflation that's very different than a period of low inflation. And so everything that worked during the bubble is not going to work this time. So you have to have a completely different portfolio than the one that worked for QE 1, 2, 3, and 4. This time it's going to be the value stocks, the non-US dollar denominated stocks, emerging markets, commodities, gold, silver, those type of portfolios. Cathie Wood doesn't own any of these stocks. Her portfolio is the opposite of what you'd want to own for the economic environment that we're now in. But I want to finish up this podcast by talking about a new government program. And, a lot of people, I get emails and people want to know, how do you have all this content, right? You do your podcasts and, you talk for a half hour, an hour, don't you run out of stuff to say? And, I don't run out of stuff to say because politicians don't run out of dumb ideas. There's just an unlimited supply of this nonsense. So it constantly gives me material to discuss on my podcast. Now, I wish politicians didn't do all these dumb things, and so I wouldn't have to talk about it. But unfortunately, they do. And since they do, well, I've got to expose it just in case some people can't figure this out on their own. But anyway, and I didn't even read about this until this morning. And in fact, there were some articles that I missed. The New York Post had an article about it a few days ago. I totally missed that. But there were a lot of stories about it today for some reason. The new policy takes effect on May 1st. So that's probably why we're starting to see these stories. Now, the government does a lot of dumb things, right? And this is probably one of the dumbest things they've done. And that's saying a lot, right? Because the bar is pretty low when it comes to, how dumb. You got to get really low to be dumber than most of the dumb things. But I think this succeeds. And this is something that the politicians, they should have learned something from their mistakes. Now, this involves housing. And here is this bright idea that the Biden administration has come up with. As we all know, you have Fannie and Freddie, which are still around, and the FHA, but the government guarantees mortgages, privately issued mortgage. So if you're a bank and if you originate a mortgage and it meets certain criteria, the government will guarantee it. So it's like the government co-signs the mortgage. Now, this should not happen, right? This is a complete mistake. The government should have no involvement in housing. If you want to borrow money to buy a house, it should be on the strength of your credit. There should be no government guarantee. And if you can't convince somebody to loan you money without a government guarantee, then you shouldn't be able to borrow the money. I mean, that's how a free market would work. Unfortunately, we don't have a free market. Certainly in housing, it's a very socialized market. And this new government rule is a perfect example of why the government has no business at all being involved in housing. We should dismantle the FHA and Fannie and Freddie. They all need to be abolished. And this is proof. As if we didn't have enough proof, right? This provides the icing on that cake, right? And so what they're now going to do, the Biden administration says that they want to encourage more underrepresented people to buy homes, right? I guess it's minorities or people that are poorer, people that have bad credit histories, right? We want more of those people to buy homes. Now, why you would want more people that have a bad history of credit? Why would you want them to buy homes? No, we don't want them buying homes at all. We don't want people who can't pay their bills taking on a mortgage, the biggest bill of all, when they can't even pay smaller bills on time. Why do we want to give these people a mortgage? That's the last thing you'd want to do. But the Biden administration wants to encourage banks to lend more money to people who don't have a good history of paying it back, right? Now, first of all, the lending business is not really about making loans, right? That's not the business. Anybody can make loans. The key to the lending business is getting paid back, right? That's what makes a business, right? You got to get your money back plus interest, right? Because if it was just about making loans, I mean, a monkey can make loans, just approve every loan that you got. The reason we have loan officers is to know which loans to reject, right? So the bank minimizes its losses because the bank is there to make a profit. Well, if you loan out money and you don't get paid back, you're not going to make a profit. So you got to loan out money to people who are going to pay it back. Now, sometimes banks might make a loan to somebody that maybe is a little riskier, right? Maybe they in a mortgage, they don't put up a big down payment. Maybe they have bad credit. To the extent that the bank is going to make that loan, it's going to have to charge a big premium to that borrower, charge him higher rate. Why? Well, they're taking more risk, right? When you take more risk, you get more return. Like if you buy a junk bond, you get a higher yield than if you buy U.S. Treasury. Why? Because you're taking extra risk. You've got to get paid for that. So if you're going to make a loan to somebody who is a worse credit risk, then you got to get a higher yield for taking that risk. Plus, also, what happens is if you make a lot of risky loans, right? You loan out money to people who may not pay you back. Some of those people won't pay you back. Well, you have to make enough money off the people who do pay you back to cover the losses on the people who don't. That's what makes it work. So you have to charge the guy that has a low FICO score, a low down payment. You got to charge that guy more. That's the only way the market is going to function. It's kind of like health insurance, which is another thing that the government screwed up. But healthy people can buy insurance cheaper than sick people. That makes sense because healthy people are probably not going to put in a claim. And because they're probably not going to put in a claim, the insurance companies can sell them a policy with a low premium. Now, if you're sick and you're likely to start putting in claims, well, you're going to have to pay more. The way the insurance companies are able to even insure these sick people who are probably going to put in claims is because you have all these healthy people buying insurance that aren't putting in claims. They're buying something they're probably not going to need. And so the insurance companies can take those premiums and cover some sick people. But here's what happens. The government says, oh, that's not fair. We got to get rid of these pre-existing conditions. Everybody should pay the same, whether they're sick or healthy. Insurance companies shouldn't be able to discriminate. Well, the minute you do that, now they have to jack up what they pay the healthy people. Well, now the problem is the healthy people don't want to buy the policies because they're too expensive. They'll take their chances. They don't really need it. And the whole thing collapses. It doesn't function. That's why you have to then pass a law and force the healthy people to buy insurance because it's too expensive. right? But if the government just stays out of the way, the market works great and the insurance companies are able to provide coverage. Yes, if you're sick, you've got to pay more, but at least you can get a policy. When the government comes in, that the whole thing gets destroyed. But they're doing the same thing here with housing. So this is what these idiots in the Biden administration have decided to implement, right? It's already done. It's not like it had to go through Congress. Biden just said, this is it. This is how it's going to work. Now, all the banks are just going to have to do this. So there's something called, I wrote it down, hold on. Loan level price adjustments. And this is something that gets made, I guess, after the bank, these are private banks, after they have a loan, for the loan to then be, I guess, a Fannie Mae or Freddie Mac or one of these loans, they then make these adjustments before Fannie or Freddie will guarantee them. I think that's how it works. And so according to these new rules,